Now, the fund was performing, right? It was performing, but because of all the fees that were on his policy, even despite those incredible gains, he still was behind the curve. Okay. So ultimately, he was like, okay. And then I explained to him, this is what I was going to get into just before.
Okay.
What I explained to him is what is likely, because he's now 50. This year he's turning 50. So what I explained to him is that likely in the next 10, 15 years, he's going to start to receive these notices from the carrier that's going to say, we're going to need you to increase the amount of premiums that you're paying. And he was like, why would they do that?
Ouch.
I said, no.
Welcome back to the next episode of Wealth Strategies to Value. I am your host, Troy Shorts. Today we have a part 2 with Miss Lesley Batson. I would like to just reintroduce Lesley to the group. If you haven't heard the part 1, Lesley's been in the business for about 4 years. She was an IT professional in her former life, and she learned some strategies on planning, and it really changed her life. And now Lesley is in the business of teaching people how wealth really and truly works using the IBC, which is called the Infinite Banking Concept. So I've known Lesley for about 1.5 years. We're both a part of a financial planning group called iVest. And in our iVest group, what we do is we brainstorm, we research, we study, we practice, and we really sharpen our skills in order to be the best we can be in front of you, the public, and really go behind the scenes and do the work that you don't have to do so we can do it for you and provide some shortcuts for our clients and really just take them to another level. All right. So enough said. All right. So I'd like to introduce Lesley again. So say hi, Lesley.
Hello, everyone. Thanks, Troy, for having me back.
No problem. So today in this episode, we'd like to piggyback a little bit on what we started with understanding IBC and how it works and really what it's about. So today we're going to go a little bit in the weeds, right? And those of you who are friends of mine and know me well, I'm not a weed guy. You know, I like to stay 30,000 feet above sea level and be able to look down and really take a macroeconomic approach. But we're going to get down a little bit into the weeds. But before I get started, I wanted to let you know, Lesley, something that happened that was really cool.
Okay.
I got a call from one of my good buddies, one of my clients, Dr. Vespi. And Dr. Vespi said to me, I have a complaint, Troy. I said, oh, okay. Well, what's the complaint? He said, you haven't done a podcast in over a month. And he said, that young lady that you had on that podcast, he said she was absolutely amazing. He said she told a story about her client, and he said, Troy, it was the best because it was very, very relatable. And basically he could see people really understanding. And that's the feedback that I love, because it means that we're talking English to people, not Chinese. Exactly. And people can really grasp the concepts and strategies that we're talking about to make an impact, right? To make a real change in their lives, for their families, for their businesses, and for their loved ones. So
yes,
well, kudos to you, Lesley.
We don't need to be talking about it for us to understand. We already understand this thing. We need for other people to understand. So glad that people are receiving it. And thank you for the compliment from your client.
Yes. So you hear that, Dr. Vespi? We got you covered, man. We're back on the air. So today we're going to talk about insurance and the different types of insurance. Now we're going to talk more about the cash value type of insurance, where we're going to be able to build some wealth. So these different policies, there's just a word that separates the two. One is called universal life and one is called whole life. So a lot of people, they get confused. So I'm hoping today we can bring some clarity once and for all. All right. So universal life can be known as universal life. It can be known as index universal life, right? It could be known as variable universal life, right? But the universal life is the word that we're looking for. And then there's the different kind, which is called whole life. So Lesley, as an IBC practitioner, what would you tell the public? What is universal life?
All right. So I think you did a great job just identifying what the different types of, at least, are what are considered permanent life insurance, right?
Yes.
So we've got
Yes.
whole life and then the category or the family of universal life.
Yes.
And the reason that these are both considered permanent is because they both have the ability to build up some type of value inside of the policies.
Correct.
Universal life is sort of a hybrid of term life insurance and, well, I guess I don't want to say whole life, but it's really like an extended or I don't know what you want to call it, but it's almost like a type of term life insurance that will allow you to have some type of ability to build up some value. The problem with it, or at least what is usually misunderstood about universal life type of insurance products, are all of the intricacies.
Yes.
So whole life insurance is very simple. Whole life insurance has guaranteed death benefits, guaranteed premiums not to change unless you want them to, or you build in some flexibility, but they're guaranteed to not increase. And then you have that cash value. Now, of course, all of this is based on the claims paying ability of the insurance carrier that you're using, but you have all these guarantees built into whole life insurance. So it is guaranteed to be there when you pass away, assuming you've continued to do your side of things, which is continuing to pay your premium payments as scheduled. Now, with universal life insurance, how do we begin? Okay, so universal life insurance is kind of like term life insurance. So most people, if they have term life insurance, they have it for some fixed amount of time, a 10-year premium, a 20-year premium, 30-year premium. And they understand that to mean I'm going to have that same premium amount scheduled for that period, that term. Right. Let's just say we're using a 10-year term. And that 10-year term is very, 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 very cheap compared to whole life insurance. And even it's lower than universal life. Mm-hmm. But it's because in that 10-year period, actuarially speaking, the likelihood of you actually passing away in that time frame is usually extremely, extremely low, which is why the insurance companies can afford to charge you a low premium, because they have very, very low risk. Yeah. Now, universal life, what that does is it essentially says, okay, we're not going to put this 10-year time period necessarily. We're going to factor in the cost over a longer period of time. And that's why the premium costs are higher than a term life policy, but lower than a whole life policy. They also say, well, you have a lot of flexibility. You don't have to necessarily, pay your premium. You can skip this month or this year, or however it's structured, right? It's all structured differently. But I guess if you want to say the sales pitch, or the reason that people tend to want to do it, is because they kind of talk about the flexibility.
Yes. Yeah.
Now, if it's just straight universal life, that's just basically what it is. It's just a policy that would be in place as long as you're able to keep up those premium payments. Okay. An IUL, or index universal life, is similar, but what they've done is they've put this additional layer of a relationship to the index of how the market is performing. So this is the other part that entices people, because they say, oh, I can invest inside of my life insurance policy. That's great.
Yeah.
Now, what they don't necessarily understand about the IULs, and even with the variable universal lives, right? Both of them, the difference is that index universal life is saying, we will credit your account with a certain amount based on how, let's just say, the S&P index is performing. So let's just say the S&P earned 18% this year. But your IUL policy probably has a cap, meaning there's a maximum amount that they will, of profits that they will credit to you, and a floor. So the cap is probably going to be something like 9% or 10%, even though the S&P earned 18%. So you're only getting partial credit. But the reason they say, well, the flip side of that is if the S&P was negative 18, our floor is 0. So that means you're not going to have to feel the impact of negative 18% applied to your policy. Now, the challenge with that is that sounds all good and fine, but there are additional fees and additional costs with that type of policy.
Yes.
Okay. And I can't really get into all of that, but just know that there's all these additional fees and policies. There's also not necessarily any guarantees, right? Now you can purchase a guaranteed rider. I forget what they call it, but basically it's a guaranteed rider.
Yeah.
Typically it's not more than 20 years. So yes, you're kind of saying, okay, I'm willing to lock in a death benefit for 20 years. But again, that 20 years typically isn't going to take you to an age where you're likely, where actuarially speaking, you would pass away.
Right.
Okay.
Yeah.
So
Yeah.
usually by age 65, that guaranteed rider falls off.
Gone.
Okay. Now, the other, and I'll just also quickly mention with variable universal life, the difference between index universal life and variable universal life is that with variable universal life, they are actually investing your money in the market.
Yep.
So you are exposed to that risk. So if the market if S&P goes up by 18%, you're going to get that 18%. If it goes down by 18%, you're going to,
lose
that 18%. In addition to all the fees, there's even more fees with variable universal life products than there are with index.
Right.
So even though the S&P might earn 18%, like a positive 18%, if the fund that, if the fund that you're actually invested in through your life insurance company, if that fund is costing you like 3% or 4.5% or something like that, you're not actually netting 18%, you're getting, a reduced amount.
Right.
And then there's other fees and other costs. And with both IULs and VULs, the carrier has the right to change the amounts of fees. Like there's just so many variables. I guess that's the point. There's really not a lot of certainty.
Right.
But again, people say, well, I'm willing to take that risk by having my those gains insulated inside of my policy. Okay. Right. But ultimately, most people just don't understand the costs, right? The cost.
Yeah. Yeah.
And so I can give like a quick example.
Sure. I'd love it.
Okay. So I recently have a new client. He's a doctor in the Northeast, and he got he got a VUL, so a variable universal life policy on himself, and a index universal life policy on himself. Mm-hmm. This is in 2011 when he was in his 30s. Okay. All
right.
He was 37, 39, something like that. Okay. He also got a policy. He got 2 IULs on his wife.
Okay.
So together, his were about 30,000, hers about 20. So let's just say he's been paying about 55,000 in premium since 2011 into these various universal life products.
Okay.
But he came across one of my videos. He was like, learning more about life insurance, and he realized like, okay, I want to just learn more about my policy. So he contacted me, and he thought all these years, we're now in 2022, okay, all these years he thought he had whole life insurance. When I reviewed his, I had him, send me his in-force illustrations. When I reviewed them, I was like, no, none of these are whole life insurance. Like I said, one is a VUL and these other 3 are IULs. And he's like, okay, like, what does that mean? So I went through and I showed him how the amount of premiums that he had paid. So let's just take the VUL policy as an example. Mm-hmm. He had paid, I can't remember the exact numbers, but he had paid, let's just say $150,000 or something like that in premiums into that policy over this 11-year.
11 years, yeah. Right. Right.
But he only had about 80 or 90, I think, sorry, I don't want to get the numbers wrong, but he only had about
a whole lot less than what he put in.
75%. Yeah. Okay. So it's about 75% of account value.
All right.
So he was trying to figure out why, when the market had been doing so amazing all of these last few years, like why has he not even at least caught up with the premiums to the account value? So I was like, let's take a look. And so I looked at the various accounts that his money was in. Now, here's the thing. He got these policies 11 years ago. He does not, I don't even think the agent who sold them to him is even working at that company anymore. Wow. He's never had any type of annual review. Like he's never really looked at this until in the past year. Wow. And so his money's just been parked in this one fund. Now the fund was performing, right? It was performing, but because of all the fees that were on his policy, even despite those incredible gains, he still was behind the curve. Okay. So ultimately he was like, okay. And then I explained to him, this is what I was going to get into just before. Okay. What I explained to him is what is likely, because he's now 50, this year he's turning 50. So what I explained to him is that likely in the next 10, 15 years, he's going to start to receive these notices from the carrier that's going to say, we're going to need you to increase the amount of premiums that you're paying. And he was like, why would they do that?
Ouch.
So, with universal life products. So again, for those listening, whether it's universal life, index universal life, or variable universal life, there comes a time in the life of that universal life policy where, because the cost of insurance starts to increase based on the age, because they hadn't basically accounted for those costs in the earlier years, they have to now start to recoup those costs in these later years.
Right.
So the costs are higher and they need to start recouping. So what happens is they need to start requesting you, the policyholder, to pay higher amounts of the premiums. And so he's like, why would I pay a higher premium than I'm already paying? So that's just how this product works.
Yeah.
He's like, I don't want that. I don't want to be like retired and now having to come up with more money. Yeah. I just want to, have level premiums. I want to know I have a guaranteed death benefit for my wife and 3 kids.
Right.
And that type of thing. So when I showed him those costs comparatively, he was just shocked. He could not believe that it has cost him so much to have these policies in place.
I just did a quick calculation. $55,000 times 11 years is $605,000.
Okay, so there you go.
So he put away $600,000 of his own cash.
So in the VUL, because he had 2. So in the VUL, so maybe you can do that quick calculation, but I believe in that VUL he had, I think it was $15,000 a year. Honestly, I'm sorry, I should have probably pulled them up in preparation.
Well, it's fine.
But I
get the point.
But the point is really had 75% of that account value compared to the premiums that he had put in.
Wow.
Okay. So
what was his reaction? Like when you brought this to his attention, huh?
I mean, he was shocked, but then he was just pissed off, right?
Wow.
Because the one thing he did understand was that it's more cost, like the younger you are, the more cost effective it is to get life insurance.
Sure.
So he was just really upset to find out that basically now, like I said, he's turning 50 this year. So to find out that, number one, that he wasn't in a product that had a guaranteed death benefit. Now, of course, he would have been fine at this point, because that death benefit was in place. He wasn't being asked to pay anything additional. Right. But, that time would come. And so he didn't realize that and he did have that extra rider on there for the guarantee death benefit. But I explained to him that was only for 20 years. And that was, so for him, that was going to fall off at age 59.
And right? He's paying for it too. That's another fee.
Yeah, there was a fee for that rider.
Right.
So I just kind of broke down and that was just the fees that I could see from the in-force illustration. I'm sure that there were additional fees that were outlined in his actual policy at the time it was issued, but I didn't have access to that.
Right.
So he really was. So like I said, he was more. He was shocked at first, and then it was really just anger. Wow. I think anger and resentment, to be honest.
So I want to just interrupt for just 1 second because it is very, very important for people to understand how if this gentleman never met you, what would be the end of his story? Okay, compared to when he did meet you. You did educate him and you turned things around. Now look at where he's going to be as a result of meeting you. This is what I said when I said earlier how you are changing people's lives, right? By information, by knowledge, by know-how. And this is why we get up in the morning. So I love to hear your story. I don't want to cut you off, but keep going. I just wanted to throw that in there.
And this is what I love to do. Like you said, I really just love to help people understand what's really happening, To answer your question, what would happen? Probably starting in his late 50s, he'd start to get these notices to pay an additional premium. And he'd be like, why is this happening? He wouldn't understand why they're asking for this, So thankfully he did find me. Yeah. And the crazy thing about this, Troy, is when I ran the illustration, so starting at age 50, running the illustrations, even with whole life insurance, which is, quote unquote, not supposed to be, a great savings vehicle, the premiums were going to catch up with the cash value. I think it was like within 9 years or 10 years, something like that. Right. So even just with whole life insurance. He was
without the extra fees,
without all those extra fees, guaranteed death benefit, consistent, predictable, premiums that are never going to go up, having that flexibility because he still wanted to have flexibility. Yeah. So there was sort of the premium for the base insurance, but then there was that flexibility with the paid up additions. Mm-hmm. So he could put in a little bit less and put in a lot more if he wanted. He had that whole range that he could put money into because he does do some real estate investing, some other things. Okay. So he wanted the ability to, tap into the cash value and that type of thing. So when I showed him that, he's just like, and I didn't want to say it. But he actually was, wise enough to see it for himself. And he's like, why didn't this guy just sell me whole life insurance back then? If I had it back then, how much more would my, policy have been worth?
Yeah.
And so I was glad he understood the concept and what was happening. Now, the one thing I will say, and I always want people to understand, your whole life insurance policy is a savings vehicle. It is not an investment vehicle.
Yes, that's correct.
But when you're building up that capital, building up your capital reserves inside of your whole life policy, you can leverage that into other investments, right? So that's really what that's what he's starting to do now. And I'm working with him on some other, other alternate asset opportunities. But he was just really, I think he felt like he was behind now, like I think he thought he was so much further ahead.
I agree.
Yeah. So it's just really, I think, humbling for him.
Yeah. Wow. That's amazing. So how many other people are in your doctor client's position and they don't even understand it? They don't even know it.
I tell people all the time, even if you just schedule time for someone like me, Troy, someone who is a licensed insurance agent, someone who specializes in it, because any financial planner or any money manager, they're not necessarily, even though they might be licensed to sell you life insurance, it doesn't mean that they really understand how to, produce a product that is best suited for you. Right.
Exactly.
So I tell people just request an in-force illustration from your carrier and have Troy, myself, whoever actually review it and explain to you, this is what this is, right? Like, I know you may have thought it was X, but it's really Y, or here's what you also need to understand about what you have.
Yeah. It's like, I see this a lot, and, it's like, I'm gonna use women for just a second, because women buy these expensive pocketbooks, right? The pocketbook costs like $2,000, but then you could go out and buy that same pocketbook that's like $150, and it looks just like the $2,000, but it's not. It's something different, right? It's like
something different.
It's a knockoff,
Yeah.
And I'm just trying to draw a correlation between, this and that. We got to make sure we got the right stuff. We got to make sure we got the real thing, right?
Exactly. So I think it's important to say that, because of course his other question was like, why did he sell me this?
Yeah.
So, well, here's the thing. I don't know who he was. I don't know him. I don't know, if it was just a matter of, if you just said to him, okay, I'm just looking for death benefit, maybe he thought that was a good fit for you at the time. Like, I don't really know what the story was, right?
Right.
But now, since he and I have had the conversation and I know all the things he wants to do, I know for sure, any type of UL product is not what he needs or what he's looking for. He definitely needs to use whole life insurance.
Yeah.
But I can't speak to why, the guy did it. Sometimes he was just maybe incentivized by his office to, sell this product, and he got some kind of bonus. Like, I don't know that, right? It could very well just be the only product he was ever trained on.
Exactly. Yeah.
So it's not that he was trying to do something deceptive or, trying to hurt you. I mean, I think everyone who's in this industry, 99% of us are trying to do the right thing, and we want to see our clients succeed.
Yes.
But we don't all have the same level of knowledge. If we've only been given sales training and not product training, it's very different.
Yeah, I agree. I definitely agree with that. You could go to 5 different advisors, right?
Yep.
The same person, the same assets, the same income, right? The same time horizon, the same risk tolerance. Yeah. And you get 5 different solutions.
Exactly.
Right? So which one is the right one? Which one is the one that is going to be the fit for you? Exactly. So yeah, it's a tough deal. So this is why we do iVest. This is why we study. This is why we do research. This is why we make sure we dot our I's and cross our T's, right? Exactly. Because we want to make sure that we're really doing the what's in the best interest of our client, not in the best interest of us, right?
Exactly.
Because I've heard stories of some of these companies and some of these sales meetings where the companies on the stage saying to the group of agents, you got to sell this, and we're going to pay you, the highest commission possible. And, that has absolutely nothing to do with helping people.
Exactly.
That has everything to do with helping yourself.
Exactly. And I think people need to think about because the term that I hear people say is that whole life is expensive, right?
Right.
And then it's like, okay, well, compared to what? So
Compared to what?
if we're talking about, whole life compared to IUL or term, then you have to think, why are premiums higher?
Mm-hmm.
Right? Why are they higher? Well, if the likelihood of someone having a term insurance policy, it's unlikely that they would have a term life insurance policy after age, let's say 65, even 70. Like, I don't even know if there's term policies available after age 70. Okay. If it's an IUL policy, if those premiums are starting to go up at a certain age, a lot of times people are dropping the policy because they can't afford to make the extra premium payments, or they don't want to make those extra premium payments.
Right.
And what does that mean? It means that they were paying premiums for X number of years, and then that policy, they had to surrender the policy because they couldn't keep up the premium payment. So they lost all that money.
Yeah.
Hopefully they were able to take advantage of it while it was, while the policy was active.
Yeah.
But if they didn't, then that was a complete waste.
Yeah,
The reason that whole life insurance, let's say costs more, why the premiums are typically higher, is because it is there for your whole life.
Your whole life. That doesn't mean you have to pay premiums for your whole life.
Exactly.
Right? That's what people think.
Exactly. You don't have to make premium payments for your whole life.
But the benefit.
The premiums that you're paying is to say that you are guaranteed a death benefit, whether you die at 65, 85, or 105.
Right.
Right?
Guaranteed. Yeah.
Guaranteed.
Yeah. I had a mentor years ago, and he said something to me that I never forget. And he said, most policies are designed to expire before you do. And it's a way that the insurance companies can recapture those dollars, because the minute that you drop that policy, he said, they throw a little party in the back room of the insurance company, and they say,
Right.
we got, not only did we get all their premium, but we're off the hook for that $1 million death benefit, right? Because that's real cash, right? That's real money.
Exactly.
Right. And then they can redeploy that dollar to another,
to the whole life policy holders.
Yeah.
Right?
Yeah.
I mean, that's, hate to
Right.
say it that way, but that's it, right?
Yeah.
What part of the monies that are going towards them having that money to pay your family your death benefit are all those premiums that came in for products that are likely to not reach, the level of a death claim.
You got it.
Right?
You got it. Lesley, I mean, I've been around for a while, been doing this for a while, and there's just so much misinformation out here regarding this topic that we're discussing today.
Absolutely.
And I'm involved a little bit in reading some of these retirement journals and retirement blogs and retirement Facebook groups, and I'm just so appalled at some of the things that I read, and I'm appalled at so much misinformation that I read. And I feel when I read this stuff, I feel even more driven to dig my heels in, to say, hey, listen, there's a better way. There's a safer way. There's a less riskier way, right? I do it every day. I do it all the time. Like, I show people different, better, easier, safer ways of getting this tough job done, right? We live in a tough world, and we need tough plans, right? Because things happen, and we got to make sure we're got a tough plan. So
I would actually say, Troy, so one little thing, I actually don't like to use the word plan, financial plan.
Okay.
Right?
Okay.
Because you can make plans, but they change, right? What you need to do is have strategies in place, so that no matter what happens,
stand corrected. Yes.
Yeah, you can adjust it, right? And that's what I say to clients, right? It's like, we can put a plan in place and it could change tomorrow. Did you predict COVID? No. No. Did you predict recession 2008? No. Like, you can't, there's certain things you're not gonna be able to predict. If you're a business owner, did you predict that business next door was going to go out of business and that space would come available so that you could expand your business? Like, there's all kinds of things that are going to come up, planned or unplanned, good and bad.
Right.
And if you don't have strategies to be able to take advantage or be prepared, if it's an emergency, to be able to take care of that emergency, or if it's an opportunity, be able to take care of that opportunity. Yeah. You can't plan for that, but you can have strategies in place so that you're able to deploy on, no matter what situation comes up.
Right. We got to have a strategy with redundancy built in. right? That's the
Absolutely.
word, redundancy, right?
Redundancy, consistency, and control.
You got it.
Hmm.
It's like the guy who builds a bridge.
Hmm.
Well, the bridge has to withstand the wind. It has to withstand the weight of the cars. It's got to withstand the water underneath it. Like, it's redundancy. It's built in. It's got to
Absolutely.
work. It's gotta last. And
Absolutely.
I think that cash value life insurance is one of those redundancies that a lot of people don't understand how it works. And the media and I don't know who else, but they kind of boo-hoo it as if it's like the worst thing you could do. And when you really look at it, it's like, wow, like what is it that they do not understand about how this works, right?
Well, Troy, even if they do understand exactly how it works, they're not incentivized, right?
Correct.
They're incentivized to support the companies that, place ads on their channels or their papers or their websites. And that is Wall Street.
Yeah.
Right? So,
Correct.
they're incentivized by Wall Street. So
Correct.
that's who they're going to talk more about the products and investments that Wall Street offers, because that's who pays their bills.
You got it.
And they make a way more money off of that than they
Yeah.
do off of life insurance,
Yeah.
unfortunately.
Yeah.
There's I'll just say quickly before we finish,
Mhm.
a book I just finished listening to. I can't think of the guy's last name. His first name is Tillman. He's a billionaire out of Texas. He owns like the Landry restaurants and that whole family restaurants. He owns the Houston Rockets. He's a billionaire. But he has a book called Shut Up and Listen.
Oh,
Anybody who's out there who's a business owner or just a leader, or just, I would say, a leader of your family, leader of your business, whatever. I just thought I prefer to listen versus read.
sure.
But it's an excellent, excellent book.
All right. I
And
just wrote
in
it down.
several of the chapters, yes, it's called Shut Up and Listen. And he's very direct, which is, I like that. I like that. I like that approach.
Mhm.
But what I like about it is throughout the various chapters, he talks about the importance of having capital. He talks about the importance of saving and having access to cash and liquidity.
Yeah.
And it's so important, whether it's your family or your own business.
Yeah.
You cannot take advantage of, like I said, opportunities without having that access to those liquid reserves and a whole life insurance policy and that cash value. It's really just one of the best ways to be able to tap into cash that you don't have to pay taxes on right away, right? Or ever, if it's done properly.
Yeah.
It's just so smart. And he doesn't mention life insurance, so I'm not trying to say that, but he just talks about the importance of having capital and access to capital to be able to take advantage, to grow and to scale, and to be able to take care of any kind of emergencies that come up.
Yeah. Yeah. Well, I just thought came to me when you're talking about capital. One of the most savviest investors in the entire world is Warren Buffett, right?
Mhm.
I mean, I don't know the number exactly, but we all know he makes these amazing investments, right?
Yep.
But what I found out was his capital, his reserve, it's 100 billion. He doesn't make a move without 100 billion.
And he makes sure he has a minimum. Always, he will not deploy into an investment if it's going to drop him below that minimum, right?
Right.
And that's how we all need to be thinking. There's a minimum amount of cash that we need to make sure that we have access to. And you're right. And Troy, the more he invests in, the higher he raises that reserve level, right?
Yeah.
And that's just something that I try to also hammer that into clients. It's like, you should never stop saving.
Yeah.
If your assets are growing, your savings should be growing along with it, right?
Yeah.
So, yeah.
It's a fundamental principle. And when I meet clients sometimes and they're all gung-ho in the stock market, and I'm saying, well, how much of your capital do you have on reserve? They've got like $5,000 in a savings account.
Right.
And I'm like, whoa, no. That's
like
not going to work.
$100,000 in a 401k. I'm like, okay.
Yeah. You're putting 15,000 in a risky taxable investment. You got 5, and you got debt. You got credit card stuff. What? You're out of balance.
Yeah, exactly.
Stop. Just stop.
Yeah.
All right. We're out of time. But Lesley, it was awesome today. You did an awesome job. And I just thank you for your friendship. And
of course.
I want you to continue being a superstar in our industry. And I want to, again, wish you all the luck in the world, moving forward with your clients. And hopefully we can have you back for part 3. How about that?
Anytime, Troy. Anytime. Hey, I'm just trying to keep up with you, Troy.
Yeah. Okay. Tell me anything. So that's it for this episode of Wealth Strategies to Value. I would love for you to share this podcast with people you know, people you love, and people you trust. Again, our mission is to help our clients have a safer, happier, and a much more enjoyable retirement. Until next time, signing off from Wealth Strategies to Value. Bye-bye.